Hi, my name is Taylor Moffat of Hallidine, and I am a partner managing director with a private investment banking firm. Our link is provided below. This video was put together to help answer questions for some of our clients that would like to know more about Sarbains-Oxley requirements for the company as being publicly traded. As you know, Sarbains-Oxley is a giant pile of legislation that was created after the Enron debacle to help protect shareholders from underhanded accounting techniques and loose financial controls. So Sarbains-Oxley has quite successfully created a large pile of accounting controls that you'll get to tolerate. And it's the most stringent set of financial controls anywhere in the world that has ever existed. What does this mean to me? There's a whole pile of information about Sarbains-Oxley requirements. First off, the financial controls means internally, you can't just have a bunch of cash in a sock drawer or a little metal box and just move cash in and out and not keep track of things. You have to keep track of everything. Inventory, you have to keep track of everything digitally. So there are a lot of different ways you can do that, but the simplified version is to just digitize everything and make sure that every transaction is digitized and tracked. And then that way you've got a lot of eyeballs on it and you don't have to worry about the financial controls side of things. So number one, digitize everything and make sure that there are a lot of eyeballs on everything. And that simplifies 99% of your internal Sarbains-Oxley requirements. Externally, and this is probably going to be the most difficult part, you can no longer just have one accountant keeping track of things. You have to have another accountant to check the first accountant. So what you can do is you can have a CPA or your regular accountant do your accounting, but then the second one needs to be a member of the PCAOB. PCAOB accounting firm stands for Public Company Accounting Oversight Board. So the accountant has to be a member of the Public Company Accounting Oversight Board. And does this mean that they're going to do anything special and that they're going to wear masks or anything? No, it's just an audit. It just costs 3 times as much. That's really the only difference. The accounting that they use is going to be a little different than your standard GAAP type accounting. Instead of looking at, let's just say, for example, if you bought a building and your cost basis on the building was $5,000 50 years ago, and today the building is worth $2 million, you can't put $2 million on the books. You have to put your cost basis of the actual item. And if you had put money into it, you can include the cost basis of the cash that you've put into it. But they're not going to allow any of what a banker would call straw equity. So everything is by cost basis. This is kind of a problem for some companies because they acquired things and got good deals, or maybe they acquired something with stock and their cost basis was 0. If you acquired something with stock, it goes on your balance sheet as 0 under Sarbains-Oxley PCAOB accounting standards because everything's by cost basis. And I think those are going to be the primary hurdles that you face and changes that you have to make as you're dealing with Sarbains-Oxley. You're probably going to want to have somebody that can at least serve on your board as a financial expert that's very familiar with Sarbains-Oxley. At our firm, we provide people that can be a financial expert to serve on your board and to help provide that, to meet that requirement. Then that way you've got, an extra set of eyeballs on things to make sure that things are going appropriately. But I think as long as you just remember those 2 easy steps, you're going to be just fine. Number 1, digitize everything. Number 2, your second accountant needs to be a member of a PCAOB, and that should take care of everything. I hope that was a helpful little video, and feel free to check back to see some more of our information.